Right now, global financial markets look calm. Stock indexes are near record highs. Volatility is low. Credit markets appear stable. Most investors believe the worst is behind us. But here's a fact that rarely gets talked about. Financial systems don't break when fear is loud. They break when everything looks fine. In the months before the 2008 financial crisis, markets were calm. In early 2000, before the dot-com crash, markets were calm. In late 2019, right before the world shut down, markets were calm. Each time, stability wasn't a sign of strength. It was a warning. Today, we're seeing the same pattern again, not because the economy is perfect, but because something critical is quietly disappearing beneath the surface. Liquidity. Not money, not headlines, not central bank promises, but the actual ability of the financial system to absorb stress, move capital smoothly, and function when conditions suddenly change. This video explains why liquidity can vanish without warning, why markets often look calm right before they break, and why this quiet risk is not being priced in until it's too late. To understand what's happening now, we first need to understand what liquidity really is. When people hear the word liquidity, most of them think of one thing: money. They assume that if there's a lot of money in the system, markets must be liquid. If central banks are printing, if interest rates are low, if asset prices are rising, then liquidity must be abundant. But that assumption is wrong. Liquidity is not money. Liquidity is movement. It's the ability to turn an asset into cash quickly without changing its price too much. It's the confidence that when you want to sell, there will be a buyer. And when you want to buy, there will be a seller at a reasonable price. You can have plenty of money in a system and still have terrible liquidity. A simple example makes this clearer. Imagine a small town with one house for sale. A buyer shows up with cash, but no one else wants to sell their house. That buyer has money, but the market is illiquid. Prices jump wildly because there are no alternatives. Now imagine a big city with thousands of buyers and sellers. Prices move smoothly because transactions can happen easily. That's liquidity. In financial markets, liquidity comes from participants who are willing to stand in the middle, buying when others want to sell and selling when others want to buy. These participants are called intermediaries or market makers. They don't exist to predict the future. They exist to keep markets functioning. And here's the key point. Liquidity depends on willingness, not just ability. A bank, a dealer, or a fund might technically have the money to buy assets during stress. But if they are unwilling, because of risk limits, regulations, or fear, liquidity disappears. This is why liquidity is fragile. It's psychological as much as financial. Another way to think about liquidity is as trust. When markets are liquid, participants trust that prices reflect reality, that funding will be available tomorrow, and that exits will exist when needed. When that trust erodes, liquidity vanishes, even if nothing obvious has broken yet. And this is what makes liquidity crises so dangerous. They don't start with defaults. They don't start with bankruptcies. They start with hesitation. One player steps back. Another raises funding costs slightly. A third decides not to quote prices as tightly as before. Individually, these decisions seem rational and small. Collectively, they drain liquidity from the system. Prices may not move much at first. Markets can still look calm. But beneath the surface, the ability to absorb stress is weakening. And because liquidity isn't directly visible on a screen, unlike prices or indexes, most investors don't notice until it's already gone. To understand why this matters so much today, we need to look at how liquidity used to be created and how that system quietly changed after the last major crisis. To understand why liquidity is fragile today, we need to look at how it worked in the past. For most of modern financial history, liquidity was created by banks. Large commercial and investment banks didn't just lend money or advise clients. They acted as shock absorbers for the entire system. When markets became unbalanced, banks used their balance sheets to keep things moving. Here's how that worked in practice. Imagine a large pension fund wants to sell $1 billion worth of bonds. Maybe they need cash for payouts, or they're rebalancing their portfolio. If there aren't enough buyers at that moment, prices would normally fall sharply. In the old system, banks stepped in. They bought the bonds themselves, held them on their balance sheets, and waited for buyers to return. They didn't need to know whether prices would go up or down tomorrow. Their job was to bridge time, to keep markets functioning when supply and demand didn't match perfectly. This is what market making really means. Banks held inventory. They quoted prices even during stress. They absorbed short-term losses to maintain long-term stability. Liquidity, in this system, came from balance sheet capacity. As markets grew larger, bank balance sheets expanded alongside them. More trading meant more inventory. More inventory meant more liquidity. This is why older market crises often unfolded more slowly. Volatility rose, but markets didn't immediately seize up. There was friction, but there were buffers. Of course, this system had flaws. Banks took too much risk. Leverage was high. Incentives were distorted. And in 2008, those weaknesses became impossible to ignore. When the global financial crisis hit, banks weren't just shock absorbers. They were the source of the shock. And that led to a fundamental redesign of the financial system. After 2008, policymakers made a clear decision. Banks would never again be allowed to put the system at risk the way they had before. Capital requirements were raised dramatically. Leverage was restricted. Trading activities were separated from core banking. Stress tests became routine. Market-making inventories were discouraged. From a safety perspective, this made sense, but it also changed something critical. Banks stopped acting like shock absorbers. Today, banks are designed to survive stress, not absorb it. Their priority is regulatory compliance, capital preservation, and risk reduction, not market stability. When volatility rises now, banks don't lean in, they step back. They reduce inventory. They widen bid-ask spreads. They limit exposure. They protect their balance sheets. This shift didn't remove risk from the system. It moved it elsewhere. And that's where the real problem begins. Because the system still needs liquidity, markets still need intermediaries. Buyers and sellers still don't line up perfectly. So if banks no longer provide that buffer, who does? That question leads directly to the modern illusion of liquidity, and why today's calm markets are far more fragile than they appear. When banks pulled back after 2008, liquidity didn't disappear overnight. At first, markets seemed to adapt just fine. Trading volumes recovered, asset prices rose, new financial products emerged. To most observers, it looked like the system had become both safer and more efficient. But beneath that surface, something fundamental had changed. Liquidity was no longer being created by institutions that could absorb risk during stress. It was being created by participants who could only provide liquidity as long as conditions stayed calm. This is the key structural shift most investors miss. Before 2008, liquidity was balance sheet driven. After 2008, liquidity became flow driven. Instead of banks holding inventory, markets began to rely on constant flows of buyers and sellers. As long as money kept moving in predictable directions, everything worked. Prices stayed stable, volatility stayed low. But if those flows ever reversed, there would be no buffer. One of the clearest examples of this shift is the explosive growth of passive investing. Exchange-traded funds and index funds now dominate large parts of equity and bond markets. These vehicles don't decide when to buy or sell based on fundamentals or stress conditions. They buy when money flows in, and they sell when money flows out. That works beautifully in calm markets. But during stress, passive vehicles don't absorb shocks. They transmit them. If investors rush to exit, ETFs are forced to sell underlying assets regardless of price. That selling pressure moves prices lower, which triggers more outflows, creating a feedback loop. Another major change was the rise of algorithmic and high-frequency trading. These firms provide liquidity by constantly quoting prices. In stable conditions, they tighten spreads and improve efficiency, but their liquidity is entirely conditional. When volatility rises beyond certain thresholds, algorithms shut off, quotes disappear, liquidity vanishes instantly. This is why modern markets often feel stable for long periods, and then gap violently with no warning. The liquidity was never deep, it was just fast. Hedge funds and non-bank financial institutions also filled part of the gap left by banks. But these players are heavily dependent on short-term funding and leverage. When funding tightens, they are forced to reduce exposure quickly. Again, this works fine until it doesn't. The system now relies on participants who all behave in similar ways under stress. They pull back at the same time. They sell at the same time. They reduce risk simultaneously. This creates a dangerous form of synchronization. In the old system, banks might step in while others stepped out. Today, almost everyone steps back together, and this is why modern liquidity is so deceptive. It looks abundant when nothing is happening. It disappears precisely when it's needed most. To understand why markets can remain calm even as this fragility builds, we need to look at volatility, and why low volatility itself is a warning sign. Most investors are taught to fear volatility. When markets swing wildly, headlines turn negative, portfolios fluctuate, and uncertainty rises. Volatility feels dangerous, calm feels safe. But in financial history, that intuition is often backwards. Periods of low volatility are frequently when risk is quietly building. Here's why. Modern financial markets are heavily influenced by models. Risk models, portfolio allocation models, volatility targeting strategies, and value at risk calculations all use recent market behavior to decide how much risk is acceptable. When volatility is low, these models send the same signal across the system. Risk is low, exposure can increase. As a result, investors increase leverage, allocate more capital to risk assets, reduce hedging, rely on liquidity being available if conditions change. This behavior doesn't show up immediately in prices. In fact, it often pushes prices higher and volatility even lower. Calm markets reward risk-taking. Now think about what this does to the system as a whole. Positions become crowded, leverage quietly rises, funding becomes tightly interconnected. Small shocks matter more. It's like compressing a spring. As long as the pressure is applied slowly and evenly, nothing appears wrong. The spring looks stable, controlled, calm. But the more it's compressed, the more violent the release becomes when something finally goes wrong. This is why calm markets are dangerous. They don't reflect the absence of risk, they reflect the postponement of volatility. Another way to think about it is insurance. When everything feels safe, insurance looks unnecessary. People cancel protection. They stop paying for downside hedges. They assume they'll be able to react in time. But liquidity crises don't allow time. When volatility finally returns, it doesn't arrive gently. It arrives all at once. Prices gap. Liquidity evaporates. Exits disappear. And by the time investors realize something has changed, the opportunity to respond has already passed. This is exactly why markets often look calm right before they break. The calm itself is the condition that allows fragility to build unnoticed. To see how this fragility actually turns into a crisis, we need to look at the part of the system where liquidity truly lives, funding markets. To understand how a quiet liquidity problem turns into a full-blown market event, we need to look at funding. Because liquidity doesn't disappear first in stock prices or headlines, it disappears in funding markets. Most people assume that when an investor buys an asset, they pay for it in full and simply hold it. In reality, a large part of the financial system runs on borrowed money. Banks, hedge funds, dealers, and even some asset managers finance their positions using short-term loans. These loans are often rolled over daily or weekly, not locked in for years. The system works smoothly until it doesn't. One of the most important funding mechanisms is the repo market, short for repurchase agreement. In simple terms, it works like this. An institution borrows cash and provides high-quality collateral, such as government bonds, as security. The next day, the loan is rolled over. As long as everyone trusts the collateral and the borrower, this process continues effortlessly. Funding feels permanent, even though it's technically very short-term. But here's the danger. If lenders become even slightly uncomfortable, they don't need to stop lending entirely. They can charge higher interest, demand more collateral, shorten loan terms, refuse to roll funding over. Each of these actions reduces liquidity. Now imagine this happening across the system at the same time. Funding costs rise, leverage becomes more expensive. Borrowers are forced to reduce positions. This selling pressure doesn't come from fear or opinion. It comes from math. If funding costs rise and leverage is no longer viable, positions must be reduced, regardless of long-term conviction. Assets are sold not because they're bad, but because cash is required. This is how liquidity crises start quietly. Prices may drift lower at first. Volatility may tick up slightly. Nothing looks dramatic. But under the surface, forced selling is beginning. And once forced selling starts, liquidity vanishes faster than most investors expect. That's because selling into a market with shrinking liquidity pushes prices down disproportionately. Lower prices trigger margin calls. Margin calls force more selling. More selling further reduces liquidity. A feedback loop forms. What makes this especially dangerous today is that funding markets are far more interconnected than they used to be. The same collateral is reused multiple times. A government bond might be pledged as collateral by one institution, then reused by another, and then reused again somewhere else. This reuse creates efficiency, but also fragility. When confidence drops, collateral reuse stops. Suddenly, the same asset can only support one loan instead of several. Liquidity shrinks instantly, without any money leaving the system. This is why liquidity crises feel sudden and shocking. They don't start with defaults. They start with hesitation in funding markets. And right now, funding conditions are quietly tightening. Interest rates are structurally higher than they were for more than a decade. Banks are more selective. Lenders are more cautious. Collateral standards are stricter. None of this shows up in stock indexes, but it changes the behavior of the entire system. To see how serious this can become, we need to look at a moment when even the safest market in the world stopped functioning, and what that revealed about modern liquidity. If liquidity can disappear anywhere, it can disappear everywhere. That reality became impossible to ignore in March 2020, when the U.S. Treasury market, the deepest, safest, most important market in the world, stopped functioning properly. This wasn't a credit crisis. The U.S. government wasn't about to default. There was no question about repayment. And yet, investors couldn't sell treasuries without sharply moving prices. Bid-ask spreads exploded. Prices gapped. Market depth vanished. Even institutions that had relied on treasuries as instant liquidity suddenly found there were no buyers. This moment shocked policymakers. Treasuries are supposed to be the ultimate liquid asset. They're used as collateral across the entire global financial system. If treasuries aren't liquid, nothing is. So what went wrong? The problem wasn't fear, it was structure. Over the years, the treasury market had grown enormously. Government borrowing increased. Issuance surged. At the same time, the capacity of primary dealers, the banks responsible for making markets and treasuries, did not grow at the same pace. Their balance sheets were constrained by post-2008 regulations. Capital charges discouraged them from holding large inventories. When everyone tried to sell at once, dealers simply couldn't step in. In the past, banks would have absorbed the shock. In 2020, they couldn't. The Federal Reserve was forced to intervene at unprecedented speed and scale. It didn't step in because the economy had already collapsed. It stepped in because the plumbing of the financial system was breaking. This is a crucial point. Liquidity crises don't wait for recessions. They create them. And the conditions today are even more fragile. Treasury issuance is now far larger than it was in 2020. Government deficits remain high. The supply of bonds continues to grow. But dealer balance sheets have not expanded proportionally. That means the system relies even more heavily on smooth flows and calm conditions. As long as investors keep buying, everything works. If those flows reverse, there is very little shock absorption. The Treasury market episode wasn't an anomaly. It was a warning. It showed that modern markets can appear stable while being structurally fragile. It revealed that liquidity is no longer guaranteed, even in places we assume are safest. And because treasuries sit at the center of the global financial system, stress here doesn't stay contained. It spreads outward. To understand how this stress travels across borders and affects the rest of the world, we need to look at the global dollar system and why dollar liquidity is quietly tightening everywhere. The global financial system doesn't run on dozens of currencies. It runs on one, the US dollar. Most international trade is priced in dollars. Global commodities are settled in dollars. A huge share of cross-border loans, bonds, and derivatives are denominated in dollars. Even companies and banks outside the United States rely on dollar funding to operate. This creates what economists call the global dollar system. At its core, this system depends on one assumption. Dollars will always be available when needed. For years, that assumption held. U.S. interest rates were low. Dollar funding was cheap. Central banks around the world could borrow dollars easily, swap currencies smoothly, and roll over debt without stress. But that environment has changed. When U.S. interest rates rise, dollars become more expensive globally. Foreign banks have to pay more to borrow. Currency hedging costs increase. Refinancing becomes harder. This creates a subtle but powerful chain reaction. As dollar funding tightens, global institutions reduce risk, they cut lending, they sell assets, they hoard cash. That behavior increases demand for dollars even more, which tightens liquidity further. It's a self-reinforcing loop. A stronger dollar doesn't just reflect U.S. strength. It often reflects global stress. This stress usually appears first in places most investors never watch. In cross-currency basis, swaps, in offshore funding markets, and the cost of hedging dollar exposure. These are the early warning signals of a liquidity problem spreading across borders. And because so many institutions depend on dollar funding, stress in the dollar system doesn't stay isolated. It moves quickly. Emerging markets feel it first, then smaller developed economies. Eventually, it reaches major financial centers. The danger isn't that one country fails. The danger is that the system becomes synchronized. When everyone needs dollars at the same time, liquidity disappears everywhere at once. And this is why global liquidity crises escalate so fast. They aren't about one bad actor or one broken economy. They're about a shared dependency on a funding system that tightens under pressure. Markets may still look calm, equity indexes may still hold up, but beneath the surface, the foundation that connects global markets is under strain. The next question is whether central banks can step in the way they always have, or whether this time their options are more limited than markets assume. For more than a decade, markets learned a powerful lesson. Whenever something broke, central banks stepped in. In 2008, they cut rates to zero and launched massive asset purchases. In the European debt crisis, they promised to do whatever it takes. In 2020, they flooded markets with liquidity almost overnight. Each time the result was the same. Markets stabilized, asset prices recovered, volatility collapsed. Over time, this created a belief that liquidity would always be restored quickly, that central banks were an unlimited backstop, that no matter how fragile the system became, intervention would arrive in time. But that belief is now being tested. The world has changed in one crucial way. Inflation returned. For years, central banks operated in a low inflation environment. They could support markets aggressively without worrying about rising prices. Liquidity injections didn't spill into consumer inflation in a meaningful way. That is no longer true. Today, central banks face a dilemma they haven't had to confront in decades. If they step in too aggressively to stabilize markets, they risk reigniting inflation. If they hold back to protect price stability, they risk allowing financial stress to grow. This trade-off matters. It means central bank responses may be slower, more cautious, more limited, politically constrained. Markets, however, are still behaving as if the old playbook applies. Risk-taking assumes that liquidity will be restored quickly. Valuations assume that drawdowns will be shallow. Funding structures assume that stress will be temporary. But central banks are now operating with one hand tied. Even if they want to intervene, they may hesitate longer than markets expect. And in liquidity crises, timing is everything. Delays matter. Liquidity doesn't deteriorate linearly, it collapses. Small delays can turn manageable stress into systemic events. Another important constraint is credibility. After years of intervention, markets have become dependent on central banks. But credibility isn't infinite. Each intervention carries political costs, distributional consequences, and public scrutiny. At some point, policymakers are forced to choose which markets to support and which to let reprice. That choice is deeply uncomfortable, and markets are not pricing it in. This doesn't mean central banks won't act at all. It means they may act later than expected, with more conditions and with less force. And that increases the risk that liquidity problems become market problems before help arrives. To understand how this unfolds in real time, we need to look at the typical pattern of a liquidity crisis and why it always feels sudden in hindsight. Liquidity crises don't arrive like explosions. They unfold like a chain reaction. At first, almost nothing seems wrong. Funding costs tick up slightly. Bid-ask spreads widen just a little. Some traders pull back, not because they're scared, but because models tell them to reduce exposure. Markets still look calm. Prices may even rise. Volatility remains low. This is the most dangerous phase because it convinces people that concerns were overblown. Then something small happens. It could be a weak bond auction, a large fund announcing redemption limits, a sudden jump in repo rates, a geopolitical event that disrupts collateral flows, a single institution failing to roll over short-term funding. On its own, none of these events should cause a crisis. But in a system already short on liquidity, they don't stay isolated. Selling begins, not out of panic, but necessity. Prices move lower than expected. Liquidity providers step back. Models trigger further risk reduction. Now the feedback loop accelerates. Lower prices lead to margin calls. Margin calls force more selling. More selling overwhelms remaining liquidity. At this point, markets don't move smoothly. They gap. This is why liquidity-driven sell-offs feel violent and irrational. Prices overshoot fundamentals because the issue isn't value. It's function. Markets aren't asking, what is this asset worth? They're asking, can I sell this at all? Only after this phase do policymakers step in visibly. Liquidity facilities are announced, emergency measures are rolled out, confidence slowly returns. But by then, prices have already repriced. This pattern repeats throughout financial history because it's rooted in structure, not emotion. The same sequence appears again and again, only the trigger changes. Which brings us to the final and most important question. If this pattern is so consistent, why don't markets price it in ahead of time? Markets don't break when fear is loud. They break when confidence is highest. Calm markets don't mean risk has disappeared. They often mean it has been quietly compressed beneath the surface. Liquidity doesn't vanish gradually or politely. It disappears suddenly when everyone needs it at once. Today's stability may reflect suppressed volatility and fragile funding rather than real resilience. The danger isn't panic. The danger is assuming calm equals safety. Because in financial history, calm is often the warning.